G'day everyone, welcome to this update of the Australian and American markets and what's happening around the world for the 22nd of February. After 3 months of consolidation and a fair amount of volatility in the American market, we finally saw a very significant move on Friday night. The US S&P 500 index blasted through 2100 points and set a new all-time high, and it just shows you what the strength of the momentum is in the buying in America. So we're back into strong uptrend again now, and as I've been saying now for quite some time, I think there's a very good chance that 2015 could be an even better year for the US market than what we saw in 2014. So let's have a look at the action for last week. As I said, the S&P absolutely blasted through 2100. It didn't just slip through by a small margin. It had a very strong move on Friday night, and it didn't take very long to do it. The 2100 level was a bit of a psychological level, and it only paused for a couple of days around there, very little pullback, and so that's a very strong sign. It only ended up 13 points. It was only a 4-day trading week in America, but as I said, it was all in Friday that told the story. So I continue to expect, as long as you're very selective about the sectors and about the stocks and about the value, I still expect 2015 to be a strong year and quite probably better than 2014. Now, in Australia, the index, the ASX 200 index, ended up 4 points for the week. But as I've been saying now for some time, the higher this market goes, there is no fundamental basis for why the Australian market is going up, no value basis. And as a consequence of that, the risks are rising quite strongly. The money that's powering these bank stocks and high-yielding stocks higher is at least partly overseas money, and they're not looking at value at all. They're purely looking at the relationship between interest rates and the dividend yield, and that's a dangerous game when you start to get to these sort of levels. So I certainly have some concerns about the valuation in the Australian market, and it wouldn't take much of a change in sentiment in stocks globally for our market to come back quite sharply. Now, there is some money tentatively starting to flow into some resource stocks, but my very strong advice to you is not to get enticed into that yet. I don't believe that oil has bottomed, and I don't believe that commodity prices in general are going to turn around anytime soon. So you see this in overall bear markets and even in the phase one basing pattern after a substantial fall. You see little rallies where people try to front run the market, try to get in before everybody else. But if the fundamentals aren't there, then they just end up retracing back again. And I believe that's the high probability of where we are right now. So let's take a look at a couple of those index charts. We'll start with the S&P 500. So you can see that with the moving average, the red line is still moving up quite strongly. Despite the 3 months of consolidation, which really started here in America in December, it didn't really break that moving average, and now we've shot away again. You can see new all-time highs, and if I zero in on this, you can see it really was a very strong session on Friday night. Closed right on the highs and buying right into the finish. So that's very positive. If you look at the NASDAQ index, then you can see exactly the same pattern here with the NASDAQ, extremely strong and getting back close to the all-time highs in 2000 before the NASDAQ market fell by about 80%. But it certainly surpassed the secondary peak in the NASDAQ, so it's looking pretty positive there as well. Now, the Australian market, just by comparison, certainly had a good month or two. Really took off about a month ago, was trading at 5,300 points, and now we're we're starting to knock on the door of 6,000 points. Don't be sucked in by that. As I said, the risks in the Australian market are increasing. Every time the market goes up, the risks are getting higher and higher, whereas that is not the same situation in America. There are American stocks, the ones that I'm involved in, that despite the price rises, the value is still there because the price rises are only just keeping pace with the growth in earnings. They were cheap and they were attractive a year ago, and the ones that I'm focused on still remain in that category. Turning now to gold. Gold fell $28 on the week, back down to 1,200 level, and that's disappointing if you were looking for a new bull market in gold. I can tell you that the supply and demand situation still strongly supports a higher gold price. There's no question about that. China is importing massive amounts of gold. China and Russia, who are the number one and number two gold producers in the world, don't sell any of their gold. They hoard it all. So we've got this amazing suction of gold into the Chinese market, and nothing's coming out. And the amount of gold that's going in there is actually, on an annualized basis, is greater than all the gold mined in a year. So the supply and demand situation of physical gold remains extremely favourable. It's just the price action that is the concern at the moment. The bit of positive news is that gold stocks continue to outperform, and we'll have a look at the HUI index, which is a good indicator for what the gold stocks are doing overall. And it's still okay for a new bull market. I wouldn't want to see it drop any further, but it's still okay at this stage. Part of the reason for the fall in gold is the US dollar strength, but that's only part of the reason, and I'm not really sure what the other part of the reason is. There's a number of potential factors, but look, nobody really knows with clarity what's driving the gold price at the moment. So let's take a look at gold. We'll look first of all on a weekly chart. You can see we're still in this phase one base. I was hoping that this time we would move higher and break out, particularly after we had this false break of the lows. And it spent about 2 or 3 months around that level and then started to move higher. It's not until we start to break down again below 1190 that I would be really quite concerned. If we're going into a new bull market soon, there shouldn't be any breakdown below 1190. So that's the key level to watch. If we just zero in on a daily chart, you can see it was pretty much all downhill last week for gold. Now just a quick look at the HUI index. So you can see it's looking a heck of a lot better than the price of gold is. So that's positive because gold stocks will always tend to lead the price of gold. And I've had this pathway drawn out now for quite a number of weeks. It's not unusual after a sharp rise to get a pullback. I was hoping that the pullback would only be to this 38.2% Fibonacci level. It held there for a little bit. It's falling back now towards the 50% level. I don't really want it to go below that 50% level. So around about 1180 on the HUI is my kind of line in the sand. So that's the gold market. Copper steady at $2.60, and it's really just sitting there in keeping with the US dollar. So not much change there in copper. Crude oil got up to $54, came off a low of 45, and now has slipped back a little bit to 50, which is exactly what I expected to happen. This is just a rally in a bear market, and I believe we're going back down again to form a secondary low. Certainly history indicates when we've had similar crashes in oil of 50, 60%. We had one in 86, 87. We had another one in the 90s where the circumstances that caused that crash are very similar to what we have now. And this one I don't think is going to prove to be any different. I think we'll go down again, probably into the low 40s. and then we might be set up perhaps in 3 to 6 months' time for a decent sized rally. There's the spot copper chart. You can see it hasn't done much in the last few weeks. So just overall, the strategic approach, the US market clearly remains the focus for me. If you have any thoughts about investing according to value, and selected sectors in America offer the best value and the best growth in the world, the most reliable growth. And I just think it's absolutely chalk and cheese between the American market and the Australian market. You should be very careful about what you do in Australia from here on in. It's not to say there's not good opportunities come up from time to time. There will be, but you need to be extremely clear about what you want, and you need to be extremely clear about the price you're prepared to pay, and then you've got to be disciplined and patient to wait for it. It just means that it's much more tricky to make safe, reliable returns in Australia. There is a profitable and reliable alternative if you're not really of a mind to be investing overseas yourself, because you may not understand the stocks, you may have questions about currency, you may have questions about all sorts of things. There is a very reliable and profitable alternative, and we'll be releasing some details on that hopefully in the next week. That's it for this week. Cheers.